Hi everyone and welcome. Hopefully everyone's logged on. We've given everybody a couple of minutes just to get registered and set up, so we shall begin as it's just a minute past 12. So welcome everybody, I'm Kerry Hull, Marketing Manager here at Paystream, and we're really excited to be delivering our first ever webinar on tax planning for limited company contractors. Your host for today will be Arif Patel, who's our Senior Accounts Manager.
Hello everybody, hope you're well. I'm a qualified accountant with ACCA and I've been working with contractors for a number of years.
And Joe Alderson, our Senior Personal Tax Manager.
Hi, I'm Joe. I've also been with Paystream for a number of years and I'm currently leading up the tax compliance team.
So as I've just mentioned there, both of these guys are very experienced members of the team and have been with Paystream for a number of years, so we're very well equipped to be answering all of your questions. Before we begin, there are a couple of things we'd like to cover off. Firstly, we just want to highlight where and how you choose the relevant audio options to ensure you can hear us correctly. And secondly, where the feature is for you to submit your questions during the live presentation. Please do send your questions over as we go along, and we're going to try our best to get through them all during the live Q&A session that will be held at the end of the presentation. However, if your question isn't answered, don't worry, because we will be providing questions shortly after the webinar. I'll now hand over to Arif and Joe.
Thank you very much, Kerry. So before we start, let's take a look at the agenda for today. First thing we'll discuss is looking at the key actions prior to the end of the current tax year. Moving on from there, we can review the tax rates and thresholds for the upcoming 2018-19 year, discuss some of the key decisions all contractors should make for the new tax year, have a look at the timeline of events following the end of the 17-18 tax year, and finally, a more detailed look at the personal self-assessment tax return, which most contractors are required to file. Joe will talk you through everything you need to know about that. So to start us off, we're now just over a week away from the end of the 17-18 tax year. So this is actually a great time to review your company and personal financial and tax position to ensure you have made good use of all your tax allowances. Consider any final tax planning options that may be beneficial, and also just a bit of a tidy up for any outstanding administration tasks you are yet to complete. The first item to consider is in regards to your personal income and to ensure you've made use of your full personal allowance. As you all know, the personal allowance is the amount each individual can earn in the tax year without incurring any income tax. The allowance for 2017-18 tax year is £11,500. So if your total income has not been up to the personal allowance amount, now would be the time to consider any additional salary or dividends to make use of this tax-free allowance amount. Remember, any unused personal allowance cannot be carried forward to future tax years. Now, most contractors will use the majority of their personal allowance from the salary they take from the company. So it's really important to review and ensure your salary level has been efficient over the last 12 months. The most tax efficient salary for the 2017-18 year was £155 if taken weekly, or £680 if this was taken monthly. At this salary level, you would ensure you are using as much of your personal allowance as possible without incurring any national insurance as an employer or an employee. This salary amount would also ensure you receive a qualifying year for state benefit purposes, such as the state pension, making it really important to have a tax efficient salary amount. Most contractors would have actually set their salary amount at the start of the tax year in order to ensure they were working tax efficiently. For those of you that may have taken a break during the year, however, and stopped taking a salary whilst on that break, now would be the right time to process any additional salary required to take your annual salary income to the tax efficient amount. Remember, as a director, you are able to process any additional salary you require prior to the start of the next tax year.
As well as utilising your personal allowance and making sure that you've taken a tax efficient salary, you should also try to make use of the dividend allowance. For 2017-18, this allowance will remain unchanged at £5,000. This allowance allows the first £5,000 of dividend income to be taxed at 0%. In other words, it's tax-free. It's always beneficial to ensure that you fill this £5,000 of dividend income if possible, as you pay no tax on that amount regardless of which tax band it falls into. It may also be tax efficient to draw dividends beyond the personal allowance. If your total income falls within the basic rate tax threshold, any dividends received in excess of the first £5,000 will only be taxed at 7.5%. Now, this is considerably less than the 20% tax due on any salary that you draw. In addition to this, your company will not pay any national insurance contributions on any dividends distributed.
Thank you, Joe. It's also really important to ensure you have submitted all of your expenses. Now, submitting expenses is an admin task that is at times put off or delayed by some contractors. So if you haven't done so already, get these expenses entered into your accounting system. Doing so will ensure your management accounts are up to date and company profits are correctly calculated to give you an up-to-date retained profits figure. This profits figure can then be reviewed alongside your personal income calculation. So as previously mentioned, where you have profits available, you may want to take a further dividend to utilise your personal allowance, your dividend allowance, or take your income up to the higher rate threshold. Any dividends taken now or over the course of the previous 12 months should have been formally declared by you as the director. Don't forget, for each dividend taken, minutes of meetings and a tax voucher should also be produced. Following any final dividend withdrawals, a good task for you to do is to review the retained profits within your company. Now, some contractors are happy to carry these profits forward to the following tax year. It may be that taking these profits now as a dividend may incur a higher rate tax on that amount. On the other hand, some contractors will look at making an employer pension contribution from the company instead. Pension contributions are actually a great way to reduce your overall tax liability. And a final point to review is to see if you have an overdrawn director's loan account. This is where the company is owed money by you as the director. If you do have an overdrawn director's loan account and the amount owing is greater than £10,000, this can unfortunately have further tax implications. You may incur a benefit in kind charge, and your company may be required to pay some employer's national insurance. So remember, if you do have a director's loan account and if you are able to, try and get this repaid now. I'll hand you back to Joe to talk you through the 2018-19 tax rates and thresholds.
Thanks, Arif. Now, at the start of the tax year, it's always beneficial to review the tax rates and thresholds and to be aware of any changes that might impact you. From the 6th of April 2018, some of the tax thresholds will be changing. The personal allowance is going to increase to £11,850. The basic rate threshold is also going to be extended. This is going up to £46,350. The higher rate band, that's going to still apply to income up to £150,000, and then the additional rate band is unchanged too, only affecting income above that amount of £150,000. The tax rates, these are going to remain unchanged at 0% on any income within the personal allowance. Savings and non-savings income, excluding dividends, are then taxed at 20% at basic rate, 40% at higher rate, and then 45% at additional rate. Once your dividend allowance has been exceeded, dividends are then taxed at 7.5% at basic rate, 32.5% at higher rate, and 38.1% at the additional rate. These rates and thresholds will apply to most of the UK. It is important to bear in mind that the dividend allowance itself will be reducing from £5,000 to £2,000 from the 6th of April 2018. What this means is that from the 6th of April, only the first £2,000 of dividends will be tax-free. Now, this is a change that will affect most contractors who use limited companies.
So George just highlighted there some of the changes that affect your personal tax liabilities. On the other side, from a company perspective, there are no real changes to the tax rates and threshold in regards to company taxes. The corporation tax remains at 19%. So for a few years, the government have talked about their intention to reduce the rate of corporation tax. As you know, the current rate is 19%. You'll recall this was reduced from 20% in April 2017. For the moment though, there are no further reductions in the rate this coming year. A reduction in future years is maybe something we see. Similarly, the VAT registration threshold remains at £85,000. The VAT registration only becomes compulsory for a business when turnover reaches that threshold amount in a rolling 12-month period. You can, however, register your company on a voluntary basis should you want to. A lot of you guys will have registered your company for VAT and maybe even the flat rate VAT scheme already. If you are already VAT registered, the new tax year does not bring with it any changes in regards to the VAT rules, so you can continue operating your VAT scheme in the same way as before. One point worth noting, however, is to see if you are still registered on the best scheme for you, i.e. if you are registered under the flat rate VAT scheme, consider your circumstances and think, would you be better off registering under the standard rate VAT scheme, and look at making that change if that is the case. For those of you that are not registered for VAT, keep an eye on your turnover to see if this does reach the registration threshold.
Just returning to your personal tax rates and thresholds for a minute. For any of you that live in Scotland, you'll find that you'll begin to pay slightly different rates of tax as of the 6th of April 2018 to the rest of the UK. The personal allowance will be remaining the same as the rest of the UK at £11,850. However, the other thresholds and rates are all going to change. Residents in Scotland will be introduced to a starter rate band for any income up to £13,850, and income in this band is taxed at 19%. The basic rate band will then go up to £24,000 and be taxed at 20%. Following this, a new intermediate rate band is introduced up to £43,430, and this is taxed at 21%. The higher rate band then runs up to £150,000, which is taxed at 41%, and above this, the additional rate tax of 46% applies. Now, these tax rates apply to savings and non-savings income only. Dividends are taxed at the same rates and thresholds as the rest of the UK. So for those of you receiving just a small salary and most of your other income is received as dividends, these new Scottish thresholds and tax rates will probably not affect you.
Moving on then to the key decisions and actions each of you should look at for the start of the new tax year, and tax planning options to consider, not just now, but over the course of the next 12 months. First thing to do is to set your director's salary amount. Now, a director can choose to process their salary on a weekly or monthly basis. The 2018-19 tax year has seen a small increase in the national insurance thresholds. What that means is the most tax efficient salary from the 6th of April 2018 is £160 per if you choose to operate payroll weekly, or £700 if monthly. These are the most tax efficient salary levels for most contractors. However, in some cases, a different salary may be more appropriate to your circumstances. Things like IR35 or other income that you have outside of the company may have an impact on the actual salary amount you pay yourself.
Also, try to ensure that you're fully aware of the tax rates payable on any dividends that you've drawn. Dividends will always be taxed last. What this means is that if you have £40,000 of other income, such as a salary, and then you drew £10,000 of dividend income on top of that, it is your £10,000 of dividend income which would then cross partly into the higher rate threshold. Because of this, and to ensure that your calculations are correct, try to make sure that you include all of your income when working out your tax, even if that income has already been taxed at source. If any income is missed out, then you may find yourself underestimating how much tax is due on any dividends or other income not taxed at source. Because dividends are not taxed at source, you also make sure you try to set aside some money to pay the tax that's due on those whenever you make any drawings above the dividend allowance. Try to remember the rates of tax that apply to each of the thresholds and then set that amount aside. Try to be prepared as early as you can to enable yourself to be ready once any tax payments are due. Now, Arif's just going to take you through some more tax planning considerations that you should make.
Thank you, Joe. So we'll have a look at the tax planning options which should be thought about throughout the course of the coming 12 months. Firstly, let's look at capital purchases. So if you are looking at purchasing any work-related equipment, such as computers, try to make those purchases prior to the end of your company accounting year. Doing so will ensure any capital allowance claims can be made at the earliest point possible, which will in turn reduce the final corporation tax bill for your limited company. The second item is the option of paying into a pension scheme from your limited company. Now, the timing and frequency of pension contributions may be as much to do with cash flow as well as tax efficiency. You can make pension contributions as a regular payment amount, so a set amount each month, or a single lump sum payment at any point during the year. Depending on your circumstances though, start thinking about when you may want to make these contributions and how much you may want to pay in. For employer contributions to receive the corporation tax relief in the company accounting year, the contribution must be paid and cleared with the pension provider prior to the end of the company's financial year. Personal contributions should also be paid in the tax year in which you want to receive the basic rate and higher rate relief. Next up is the option of adding a B shareholder into your limited company. So in some cases, it may be appropriate and advisable to have a second shareholder within the company. As a shareholder, that individual would also then be entitled to receive a dividend from the company. Effectively, this means some of the profits may be paid to that second shareholder instead of all of the profits being paid to you. Naturally, this will mean the dividends paid to that individual will be classed as that person's income. It will in turn reduce your overall personal tax liability. We always advise, if you were to have a second shareholder, to ensure that that is a spouse. And if you have a second shareholder already, consider if the percentage of dividends you are paying that shareholder is still correct and appropriate to your individual circumstances. It's also really important to keep an eye on your personal income throughout the course of the year. That will allow you to regularly estimate your personal tax liability. Now, although the tax won't be payable immediately, it is good to budget for this in advance. That way, you can avoid running into any cash flow issues when the tax payment is actually due. Remember, if your personal tax bill is paid late, you can incur penalties and interest from HMRC for paying that after the deadline. And the final point is, which is very important, is to monitor your personal income and look out for this reaching the £100,000 level. The £100,000 threshold is the point at which a person would start to lose their personal allowance. For every £2 over 100,000, the personal allowance is reduced by £1 up to the point where the full personal allowance is lost. In the 2018-19 tax year, this would happen when your total income reaches £123,700, sorry. So the effective rate of tax for income between £100,000 and £123,700 can be up to 60%, which is very high. So if possible, avoid taking dividends to the extent your income would be over £100,000. Now, as I mentioned before, we're just over a week away from the end of the current tax year, the last day being the 5th of April 2018. The personal tax year dates are fixed for all individuals, regardless of their company accounting year. With us being so close to that date, we can look at some of the considerations and events after we pass the 5th. Firstly, remember, all personal income, salary, dividends and other sources which are dated up to this date would be included in your 2017-18 income tax calculation. So any salary or dividends processed after this date would be included in the following tax year. One of the first documents you will receive after the end of the tax year is the P60. The P60 summarises the salary income you've received in the tax year. It'll also include any P45s which have been part of your payroll calculation. You can expect to receive this from your accountant by the end of May. A further document you may see will be a P11D. This should be with you by the 6th of July. The P11D summarises the value of any taxable benefits received in the year. Taxable benefits include things like company cars, medical insurance policies, and interest-free loans received from the company. So if appropriate, a P11D will be issued for you. Both of these documents would be used when preparing your personal tax return, so it's really important you keep these in a safe place. I'm going to pass you back to Joe, who's going to take you through the personal tax return side of things in a little bit more detail.
Thanks, Arif. Now, in addition to these documents, you should also receive a letter from HMRC. Each year, HMRC will begin sending out notices to file a personal tax return from the 6th of April onwards. When you receive a notice to file a return, you are legally required to complete the return requested. It is quite common for a notice to be issued several weeks or even months after the 6th of April. The notices that HMRC send are sent by post, so do make sure that you look out for them when they're due. If you've not yet registered for self-assessment, you won't receive a notice to file a return until after you've done this. The deadline to register is the 5th of October. If you miss this deadline, HMRC can impose penalties. If you're unsure whether or not you've already registered for self-assessment, you can call HMRC. Or alternatively, if you know that you've completed a personal tax return in the past, or if you have a personal UTR number, which is 10 digits long and not the same number as your company's UTR, then you will already be registered for self-assessment. To register for self-assessment, if you do need to, you need to complete a form called an SA1, which has to be signed and posted back to HMRC for anyone that's a limited company contractor. Once you have registered and you've obtained your personal UTR number, you can complete your tax return following the end of the tax year. If you want to complete your return on paper and post it to HMRC, this must be done by the 31st of October to avoid any late filing penalties. However, if you would prefer to file your return electronically instead, the deadline is extended to the 31st of January following the paper return deadline. Again, it is important that you meet this deadline in order to avoid any penalties being charged. Now, there are a few things that you should be aware of when completing your tax return and calculating the amount of tax that you owe. The tax return itself is a detailed breakdown of all of your income received in the tax year. Now, this would include all sources of income such as salary, bank interest, dividend income, and anything else. All of your income needs to be detailed on the return, even if it has been taxed at source. Any tax that has been deducted at source is also included on your return and taken into account. The tax year itself is a 12-month period starting on the 6th of April and then ending on the 5th of April the following year. Now, it is a legal requirement for anyone who is a director, self-employed, and in many cases shareholders to file a self-assessment tax return. Before filing a return, do ensure that you have registered for self-assessment if you've not already done so. Once the tax return has been completed, the tax payable on any dividend or other income that's not taxed at source will then be calculated, and that will be due to be paid to HMRC. Now, while looking at the amount of tax that you owe, some people may find that in addition to the balancing payment, you also have to make payments on account. Now, payments on account are most often due when your total tax due exceeds £1,000. Payments on account are actually payments made towards the following tax year's bill and are included in the following year's tax return. If you happen to have paid more on account than what is due to HMRC, HMRC will simply refund you the difference. Alternatively, if your following tax bill is more than what you paid on account, you would then only be expected to pay the difference remaining. Now we're going to cover a few areas that we find that certain people struggle with and where some mistakes are commonly made on tax returns. Now, as well as your personal tax, if you have an outstanding student loan, the repayments for this are also calculated on your tax return. Any payments that you've made towards your student loan, which have been deducted at source from a salary, for example, these are also taken into account in the same way that tax deductions are. The amount of student loan repayments due will depend on how much income you've received in the year and what plan your student loan is based on. Another important thing to consider for any families that receive child benefits is to please be mindful of the high income child benefit charge. Now, this charge kicks in once any member of the household's income exceeds £50,000 for the year. Once that happens, the highest earner in the household will then have to pay the high income child benefit charge in addition to their personal tax due. This charge is effectively a repaying of all or a portion of the child benefits that your household has received. Your tax return isn't all about paying more and more tax though, because in the same way your return will include all sources of income, you can also claim tax relief on your return too. By including things like gift aid and personal pension contributions, you can reduce your tax bill. By including those on your return, they will be factored into your tax calculation and allow you a reduction to your tax liability if due. Making sure you use any allowances and beneficial reliefs will limit the amount of tax that you have to pay. Finally, don't forget the dates that your tax needs to be paid. Your balancing payment, which is any additional tax due for a given year after completing your return, needs to be paid by the 31st of January. If you have been asked to make payments on account, the first of these is also due by the 31st of January, and then the second payment on account, if due, would be by the 31st of July. Please make sure that you do make the payments by the due dates to avoid accruing any interest or further penalties on overdue amounts.
Thank you very much, Joe. From my experience, I find one of the points mentioned there, the high income child benefit charge, being missed off a tax return is one of the most common errors I see on tax returns that HMRC do raise a query with. Thank you very much, everyone. That brings us to the end of the slides today. I hope you have found that useful. Just before I hand you back to Kerry to start the question answers elements of today's session, it is important to remember, whilst the tax rates and planning options myself and Joe have explained will apply to most contractors, prior to making any decisions, it is really important you consult your dedicated accountant to ensure the course of action you do choose is correct and appropriate to your individual circumstances.
Okay, thanks guys. I found that really interesting. Hopefully everybody listening did too. We've had some fantastic questions sent through, so we're now going to move on to the Q&A session. Just a reminder, for those of you that have asked a question that's very specific, what we're going to do is we'll reply to you separately because we want the answer to be specific to your circumstances rather than just a general response. So if we move on to the first question.
So a couple of questions that have come through on the question panel. Yes, we will be sharing the slides with everyone after today's session. So if you want to review that back, then you will be able to do so. A further question I have is about paying a contribution into a personal pension, a SIP pension specifically. That is absolutely fine to do. You would need to notify the SIP pension provider. It is an employer contribution and you would receive corporation tax relief within the limited company. All you need to do is make a record of that in your company's books and records. Normally, if you notified your dedicated accountant the payments being made are pension contributions and not drawings, then that would be accounted for correctly. Joe talked about the reduction in the dividend allowance, and a couple of people have asked a question about tax efficiency of a limited company. Regardless of that reduction, it is still more tax efficient to be a limited company contractor than be an umbrella contractor. So one or two have said it is worth seeing a calculation of that, which is something that we will aim to share with you after the session as well. We have a question here on the Scottish rates of tax that Joe discussed earlier on. So those do become effective from April 2018. So that's on the 6th of April. But remember, as Joe said, these rates of the Scottish rates of tax will only impact you if you are taking a larger salary amount. Anyone that is taking the most tax efficient level of salary, i.e. £160 per week or £700 per month, will not be impacted by the Scottish tax rates. A couple of questions I've got from a few different people actually regarding B shareholders. So a B shareholder can receive a dividend, but the nature of that relationship means they're not an employee of the company and therefore cannot receive a salary from the limited company. Someone has also asked if a B shareholder can be based outside the UK. Yes, in answer to your question, they can be someone that doesn't live within the UK, but the income would still need to be potentially declared to HMRC on a self-assessment tax return within the UK, and they may need to declare that income in the country they are resident in.
A couple of questions that we had in the run-up to the webinar. So we've had a question from Solar asking, how do ISAs work within business accounts and what are the rules? That one for Joe.
An ISA is also called an individual savings account, and that allows an individual to hold savings which are free of tax on the interest. An ISA can only be held in a personal name and cannot be held in the name of a limited company. Therefore, this would not be an option for you with respect to your limited company.
Okay, another one we've had from Gary. Again, another one for Joe, I think. What are the most tax efficient pension options?
There are a number of options when it comes to personal pension schemes. For example, would you prefer to make employer contributions or personal contributions into your personal pension pot? Employer contributions are classed as tax deductible expenses for your company, and as such, they receive corporation tax relief. Because of this, these contributions can be very tax efficient as an option, but the annual allowance for contributions receiving tax relief is capped at £40,000. It is also possible to make pension payments into your pension scheme from your net earnings. Each year you can pay up to £3,600 or your net relevant earnings, whichever is higher. In order to encourage pension payments, HMRC will repay any tax already suffered on your net earnings that are paid into your pension scheme. They will do this by adding the amount of tax already paid into your pension pot. Overall, the best option for you will depend upon your individual circumstances. For more tailored advice, the best thing to do is to get in touch directly with your accountant.
Okay, another question from James. I think this one will be for Arif. Is it worth buying items for the business in order to reduce tax, such as a work laptop or phone?
So yeah, anything that you incur as a cost for business purposes, that is wholly and exclusively for the purposes of carrying out your role, is an allowable expense and will reduce your overall tax liability. So that means, for example, purchasing a computer or phone that you use predominantly for work purposes is an allowable expense. If the cost of that item had a large element of personal use, then HMRC may say that that is not an allowable expense. Other kind of expenses that can be claimed is if you work from home and use a room that is designated in your house for work only and is not used as a living room, bedroom, etc., then there may be certain allowances for household bills such as gas and electricity that can also be claimed as an expense.
Okay, another one from Julie. I've just bought a buy-to-let property and I'm declaring the rent as part of my income. Along with some cash, I got a loan solely to pay for the property in cash. Can I claim any tax relief from that loan? That's for Joe.
If you take out a personal loan and this loan is used wholly and exclusively for the purpose of the property, in other words, to buy the property as cash, then the interest charged on this loan can also be offset. Now, in 2017 and 18, the deduction from property income will be restricted to 75%, with the remaining 25% being available as a basic rate tax reduction. Going forward in 2018 and 19, 50% is given as a basic rate tax reduction and the other 50% is a reduction from your profit. And this reduction is in the amounts is carrying on year. So in short, yes, you can get relief from that loan.
Okay, we've had one from Graham. What is the best deal for a company vehicle?
So company cars is a very common question that gets asked very regularly, and it really depends upon the type of vehicle that you are thinking of purchasing and whether you will be buying the vehicle outright or leasing this through the company. If your company owns the vehicle and allows you to use it personally as well as for work purposes, this will often give a rise to a benefit in kind charge, meaning that both you as an individual will pay an additional amount of tax and your limited company will also have additional tax to pay. What that means is usually for a limited company contractor, the most tax efficient option is to actually purchase the vehicle personally and not via the limited company. If it's owned personally, you will be able to claim the approved mileage rates as set out by HMRC, which is 45 pence for the first 10,000 miles and 25 pence for any miles after 10,000. That way, you wouldn't incur any additional tax charges. There won't be any benefit in kind to pay by yourself or any additional tax payable by the company. That is a kind of general feel with company cars, but it can vary because the tax payable on a company car depends on many factors, such as the vehicle's CO2 emissions, any payments made personally towards the cost of the car, the list price of the vehicle, etc. So what I would advise is to contact your accountant, maybe with a potential couple of options of cars you are looking at, and then they would be able to advise you in a bit more detail specific to your circumstances.
Okay, so we've got time for maybe just one or two more questions. I am conscious of time. So we've had one from David. What are my options when thinking about moving to a permanent role in the next 6 to 12 months?
So there are usually two options for you when thinking about moving to a permanent role. First is you might want to look at making your company inactive, or the second option is to fully close the company down. Now, keeping the company inactive for a period of time is probably the best option if you may return to contracting in the near future. So if you know that your permanent role is only something you're going to do for a set period of time and you would like to return to contracting, keeping that company inactive would be a good option for you. Whilst the company is inactive, all your directors' responsibilities for the company would remain, which means that all the filings for the company, dealing with Companies House and HMRC will still be required. Therefore, it's always advisable to continue to stay engaged with your accountant so you don't suffer any adverse consequences. The second option would be to close the company down. Now, the steps for this is firstly to prepare a set of cessation accounts to calculate all of your taxes up to the point where the company stopped trading. Once those accounts have been prepared, you would need to pay off any company taxes that are owed. Consider what you're going to do about the profits that remain in the company at that point. Instruct HMRC, the company has stopped trading. Unfortunately, you do have to contact individual departments at HMRC in regards to all the different taxes and inform them separately. And finally, once the taxes are paid, any profits have been distributed, you close the company bank account down and then finally inform Companies House that the company can be dissolved. One of the most important considerations when deciding to close a company down is to consider what you would prefer to do or what the best option for you is in regards to any remaining profits. You have, generally speaking, two options. One is to take the remaining profits as a dividend, which will be taxed as per the rates that we've discussed today already. The second option may be, if you qualify and meet certain criteria, to take the remaining profits in the company as a capital distribution. Now, a capital distribution can have favourable tax rates rather than taking the money as a dividend. So it is always worth looking into if this option is available to you or not. Best thing to do is to speak to your dedicated accountant or tax advisor, who'll look at if you meet the eligibility criteria for that option and can lay out all the options for you so you can then make an informed choice regarding that. I'll just quickly cover some of the other questions that have been asked within the panel. So someone did ask about IR35 and when you have a mix of different assignments, some being inside of IR35 and some being outside of IR35. With IR35, it is a check that has to be completed on an assignment by assignment basis. So it's absolutely fine to run your company and work on any contracts that are inside of IR35, providing the taxes are calculated and paid correctly, and then revert to working the normal way, i.e. by taking a lower salary and the rest of your income as a dividend for any contracts that are outside of IR35. Another question asked is, if a person has rental income over a certain amount, should the director still take a salary or should the salary be reduced to nil? Normally, it's still tax advisable and tax efficient for a person to continue taking a salary even if they are using their personal allowance elsewhere. Remember, the salary that you take may be subject to 20% pay-as-you-earn income tax, but you will receive corporation tax relief at 19% for that salary, which will pretty much cancel out the majority of the pay-as-you-earn tax that's been calculated. However, by taking a salary, you will have reduced your dividend, your profits in your company, and in turn reduce the dividends that you are withdrawing from the company and give yourself less exposure to that 7.5% tax rate.
Okay, I think we're probably about there for time now, so we're going to wrap this webinar up. Thanks everyone for your questions. Had some fantastic questions through. Again, don't worry if your question hasn't been answered. We are going to ensure that everybody has a follow-up with a response to the question. We will also, as Iris mentioned, reach out to everybody with copies of the slides and the Q&As. However, as Iris has mentioned, if you do have any questions, we do always, if you're an existing PayStream contractor, direct you to your dedicated accounts team. Failing that, if you drop an email into marketing@paystream.co.uk, we will forward your question on. If you're not currently using one of our services and would like more information, please call our new business team on 0800 197 6516 or on 0161 929 6000, choosing option 1, and they'll be on hand to give you more information regarding the services that we have on offer. So that's it for today. We hope you've enjoyed today's webinar. If you have, keep an eye on our social media channels for details of more upcoming topics that we'll be discussing. Thanks everyone for listening and have a great day.
Thank you very much, everyone.
Thanks, guys.